now I know it's even like a leap for, we've been talking about just some common ideas: price control, wage controls, taxing rents. I want to move to, an area that you spent a lot of time in the end of normal, when you talked about the financial crisis, and like a lot of, why did the economics profession miss it? And then even when it was going on, why maybe the correct policy initiatives were not taken. And then even though the correct policy initiatives were not taken, or they weren't done correctly, whichever it may have been, why do we still have to credit and say, well, at least the floor didn't fall out? Why didn't the floor fall out, since we didn't actually do the correct policy initiative, or it wasn't big enough, or whatever its faults may have been? Can you kind of go through that for us, and, broad brush it for everybody? And, you don't have to get into minutia, but, just give us a good overview of that.
Well, let me just hit a couple of broad themes. I think the first thing to note about what happened in the United States in the crisis was that some basic institutions continued to function. Social Security, Medicare, Medicaid, unemployment insurance, food stamps, a whole range of things kicked in to replace incomes that a large number of people were losing. And this is a good thing. It helped to stabilize the whole economy and the society. But then there were other things that were done, I think, rather badly. And the most important one was that we basically allowed the banking sector to grow even bigger and more concentrated. And we put in some reforms in the form of the Dodd-Frank legislation, but these have been very slow to take effect. They've been resisted effectively by the financial sector all the way through, and we've basically functioned to preserve the enormous concentration of power and wealth and influence that is in the hands of the largest American banks.
Let me ask you a quick question.
Done about that, but it's a fundamental imbalance of power and disregard for, let's say, norms of proper and ethical business conduct that brought on the crisis. There was a need for accountability, a need to prosecute criminal conduct that was not done, and a need to have a restructuring of those institutions that also didn't happen. So that, to me, are the two fundamental two sides of this particular story. Yes, some core institutions that were created in the 20th century continue to work pretty well. Did we really confront the problem that's at the core of American political power, which is the excessive power of the financial sector? No, we did not confront it. By not confronting it, we've made it worse.
Let me go back to something you said right in the middle of that. You said that the finance sector has grown large and disproportionately powerful. Why is that necessarily a bad thing for an economy?
Well, normally in an economy, you do want to have a decentralized decision making, some competition, some redundancy. You want businesses to be able to have multiple sources they can go to if they're looking for loans. And if you have an extraordinarily concentrated financial sector, what tends to happen is that you get an extraordinarily concentrated corporate sector as well. So you tend to have a lot fewer small businesses, independent proprietorships, the kind of mom and pop shops that used to be the major feature of the American economy tend to get taken over by things like franchise operations. And so you get a restructuring along the lines that's suited to the functioning of these major banking system sector. Another thing that happened was that with the very large banks going in heavily into the mortgage business, they started doing mortgages on a purely statistical basis, and you got the kind of gaming of that system, which produced the debacle of mortgage finance that led to the great crash in 2008, 2009. So there are all kinds of dysfunctions that happen when you allow large institutions to go completely out of control. And when they're too big when they're as big as they are, they become both too big effectively to manage and too big for the public sector effectively to regulate them. So you have all kinds of problems that are guaranteed to continue to crop up until something is done about the structure.
Wow, that is quite profound. I didn't actually see a correlation between having a concentrated finance sector leading us to have a concentrated corporate sector, on the other end. I never even saw the correlation. My thing was, I figured.
Yeah, if you have small and deconcentrated banks, you have small bankers. They tend to deal directly with small businesses. When you have large banks, they tend to like to deal with big corporate clients. So one of the things that, if you live in New York, you observe that there's an enormous number of coffee shops and that are owned by Halliburton and drugstores and so forth that have taken over a lot of small space that used to be occupied by small independent businesses. Why is that? Because landlords like corporations because they pay their rent on time. Banks like corporations because they pool risk and they can be counted on to more or less to pay their loans. That's you can see the convenience for large entities, but it's not a good thing for diversity and the quality of life in the community.